Welcome back to the Retire Young radio show. I am your host, Joshua David, on a mission to improve that financial illiteracy worldwide. Also, don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. So, Al, as we get into this next topic, we're going to talk about retirement, or we call it our wealth bucket, right?
Right.
Now, there's a couple different investors out there. One investor, and we'll call it Investor A, started investing in 2009, right? And has experienced a pretty good bull market. So they feel that the markets go up forever. So, and the markets are going up. They have since then. Seen a couple drawdowns, but not many. There's also that investor, we'll call it Investor B, that has been investing since the 90s. And they experienced a big drop in 2000, a big drop in 2008, and now they've been in recovery mode for many years, and hopefully back a little up to where they have been in. Now, here's the question, and I guess the thought process on the psychology of a lot of people. People think the markets will always go up. And right now they are going up. So there's two people there. You have one person that feels like they're missing out on these great opportunities that we're seeing, but also we have another person that they're in euphoria right now. They think that it's always going to go up. Now, how can we help our listeners understand that even when the markets are going up, there's still ways to protect what you have? You want to be able to protect your gains, but also prevent them from a loss. So what are some techniques and strategies as a public or a novice investor? What are those techniques that we can learn to protect, but also continue on this run?
Yeah. The great combination, Josh, would be to participate as the market continues to go up, but be protected. So if it does turn around and go the opposite direction, then you are protected. And that's something that you need to be prepared for beforehand. You know, you're right. Since 2009, the market has been on a tear. You know, we've had the longest bull market that we've ever had, even after the beginning of this year, 2020, which a lot of people are hoping will end quickly.
They call it 2020.
2020 is what it was. In March, we had a 34% drawdown in the S&P 500. But that was one of the quickest drawdowns that we've ever had, with almost an equivalent quick move back up again. So you're right. A lot of people are thinking, you know what, it doesn't make any difference what happens. The Fed's always going to step in and boost this market, protect the market. Well, that's not always the case. I mean, we can't count on that. And there's nothing that we can count on or should count on without being prepared for it not being right and us being wrong. So protection. How do you provide protection? There are strategies that you can use that really mimic an insurance policy. So you can have protection on individual assets or on the markets in general. We talk about that in these classes. Also, what about just taking profits? If you have a good return and it looks like once you use our strategy, let me kind of take a step back. What our strategy does is identify areas where there are buyers and sellers. So if you know that there are sell orders sitting at a certain price level, wouldn't that maybe be a good time to take some profits and not let those profits then be taken away from you when the market does roll over?
Yeah, that's the thing. You do need that strategy that's designed to do that stuff.
Right. And a lot of people, I think, don't know how to use the right position size. And one of the things that our CLIck program, our analysis, trading, and education software shows people is how to make sure that they're using the right position, putting the right amount into any particular trade. So there's a number of different things that can be utilized. One way to provide protection is to simply just identify the right price to either enter or exit something. We want to make sure that as much as possible, the risk part of a trade, the potential that it might not go in your favor, is reduced, is minimized. And one way you do that is to identify the right price. Unfortunately, most people are into a portfolio strategy where price is really not considered. If you go into a financial advisor with a large amount of money, basically they're going to say, it's just time in the market. We need to get you in the market right away, regardless of the price and regardless of whether you have a profit or a loss. Those are all things that we think should be considered. Minimize the potential of you being wrong if you pick the right price. That's what you're doing. And then also make sure that if you have a profit, that profit stays with you and doesn't get taken away. You mentioned recovery. a lot of people that lost money when the market went down, they're just going through a period of loss recovery. That is wasted time where you're just waiting to get back to where you were before any profits can be realized.
Yeah, and that's the thing is people talk about, hey, I had a great last couple of years because I made X amount percent. Well, if you're just recovering, really the overall account didn't do that. You just recovered from those losses. And just to clarify too, with this Click platform, it's a process to help guide you through your decision process. You still have to put the terms in there, your numbers and all that stuff. So it'll guide you through that.
Right. You're customizing it to yourself.
Yeah. But imagine that. Imagine if you had something to help guide you through your process. Would that bring you more consistency or more confidence in your investment decisions, especially during retirement? And Al, the markets are going up right now. A lot of people feel like they're missing out on these great opportunities, partially because they're stuck with a broker. They're stuck in the buy and hold strategy. But here's the problem. They're losing on fees. So it's diminishing those returns because of those fees. If you want to learn more about some of those fees, learn more about how to participate in this, I think it's one of the best markets we've seen in a long time.
Oh, it is. The opportunities are fantastic.
So, a lot of listeners probably have a broker and feel like they're stuck. They're saying, oh, hey, I can't do anything because I have to call so-and-so to do this, and they're going to charge me an arm and a leg to do some of these positions that I was, hoping to get into. Now, we're seeing a lot more people want to learn how to self-direct.
Right.
And want to have, wrap their arms around their capital. Real quick here, explain what self-directing is so our listeners can say, hey, I want to be able to start to do this as well.
Well, self-directing is just taking control of your assets. In other words, you're making the decisions. You have access to many, many more choices than you would in, say, a employer-sponsored retirement plan or in many of the brokers' IRAs that they might be providing for you. The fees are a big part of it. We talk about people's financial world in two buckets. One's an income bucket and one is that wealth retirement bucket. The last thing you want to do is have a hole in the bucket. If you try to fill a bucket with water and there's a hole in the bottom, you may never get it filled. That's kind of what happens with most people's retirement plans because they're paying these high fees. And to be honest with you, most of the choices that are presented by these plan sponsors are pretty mediocre to begin with. So getting your arms around your own assets, having a self-directed IRA, for example, means you eliminate those fees. And over the course of a lifetime of maybe 40 years of investing, that can mean the difference between having hundreds of thousands of extra dollars in your account or not having them. The fees really add up. The fees really result in a negative compounding impact because every dollar that is taken away in a fee is no longer there compounding for you. Each dollar can generate another dollar, which can generate another dollar. That you want that compounding to go in your favor, not against you.
That is that. What do they call it? The eighth wonder of the world is compounding interest, and you want that to go in your favor, not against you, because that's one of those things that can make a huge impact on your portfolio in a good way or a bad way. If you want to learn more about, potential ways to lower fees, which is, self-directing, not paying somebody to make the choices that you ask them to do. Remember, they're just holding your capital and not doing anything with it unless you ask them to. And so these investing classes that Al, teaches every single week right here at the Academy, he gets into these fees. What some of these are. There's many fees that come along with a portfolio. Management fees, mutual fund fees, load fees, front end, back end. I mean, the list goes on and on. So if you want to learn more about come to one of these classes and really get started with having more comfort, but also the confidence going into retirement. Coming up next, we're going to talk more about retirement. We're going to get into how to create a trading and investment plan and how to get started. This is Josh and Al. We will be right back.